Since hitting its highest peak back in January, this particular crypto asset has dropped a staggering 87% in overall value. For retail investors, a discount that steep usually looks like a buy the dip opportunity, a rare chance to enter at the absolute floor of the market. But that lower price hides a secondary factor. There is a massive reserve of locked tokens waiting in the wings, and they are scheduled to eventually flood the market. Entering a trade based on price action alone, without accounting for those incoming tokens, makes it very easy to mistake a structural risk for a bargain. The project behind the ticker CLO is Yei Finance, a decentralized finance protocol running on the BNB smart chain. This diagram shows how Yei Finance functions as a liquidity layer, pulling lending, swapping, and cross-chain bridging into a single hub. It was originally designed to serve the SEI network, extending these connections to solve fragmented market liquidity across different chains. While the technology addresses a real-world DeFi problem, having a functional product does not automatically translate into a sustainable token price. The risk is found in the math. CLO currently has a market cap of $15 million, set against a total supply cap of 1 billion tokens. This pie chart shows that out of that billion token supply, only 13% is currently circulating on the open market. Because there is no burn mechanism to reduce the supply, that dark 87% section is guaranteed to enter the market over time. This creates heavy dilution risk. As more tokens are unlocked and sold, it places constant downward pressure on the value of the tokens already in circulation. For anyone looking to hold the asset long-term, the current mathematical structure creates a difficult environment for price appreciation. This chart shows the impact of those fundamentals, with the price falling from a 91-cent high in January down to roughly 12 cents today. Sentiment remains bearish, with trend lines showing aggressive pressure against the 10-cent horizontal support. That 10-cent level is the critical floor. It is currently the only technical structure preventing a further breakdown in price. This downward trajectory isn't a result of bad luck. It is the direct reflection of the dilution risk we've just mapped out. The project does have some strengths, including functional bridging tech and consistent daily trading volume for its size. However, the massive unlock schedule means that long-term holders face an uphill battle against future supply. While it's a difficult long-term hold, active traders can use this volatility to exploit short-term price swings as the asset reacts to support and resistance. For those pursuing an active trading strategy, CLO is available on MEXC and KuCoin, or via PancakeSwap. The key is distinguishing between a high-volatility trading tool and a long-term investment. The technology provides real utility, but the massive unlock schedule makes CLO a high-risk asset to watch closely. If this breakdown helped you navigate the tokenomics, like and subscribe for more clear-eyed crypto analysis. Are you watching for a bounce at 10 cents, or does the unlock schedule keep you away? Let us know in the comments, and remember, this is not financial advice.